If you want to get some exposure to Bitcoin, you might have considered BlackRock's Bitcoin ETF called IBIT. Could you buy shares in IBIT instead of buying Bitcoin directly? I mean, it seems like an easy way to get some Bitcoin exposure without the hassle of wallets, private keys, seed phrases, or any kind of tricky technology. But perhaps IBIT and other similar Bitcoin ETFs aren't all they're cracked up to be. And that is because if you own shares in IBIT, you don't actually own Bitcoin. Let me reiterate that. If you own shares in a Bitcoin ETF, you own 0 Bitcoin. What you own instead is a share in a Wall Street product. And if you buy IBIT instead of buying actual Bitcoin, you're giving up the very things that make Bitcoin so valuable in the first place. In this video, I'm going to break down why IBIT and other Bitcoin ETFs are no substitute for holding real Bitcoin in your own custody. So let's back this up a little. What is BlackRock's IBIT exactly? IBIT is an exchange-traded fund. That means it's a financial product that tracks the price of Bitcoin. When you buy shares of IBIT, you're not buying Bitcoin. You're buying a claim on a trust that BlackRock manages, and that trust holds Bitcoin on your behalf with a custodian, which in this case is Coinbase. So instead of actual Bitcoin, you get a piece of paper, well, technically an electronic entry, which states that you own a share in BlackRock's Bitcoin fund. All retail shares are secondary market shares, and only authorized participants, or APs, otherwise known as large institutional investors, can create or redeem IBIT shares directly with BlackRock. And shares are always held by a custodian, which will most likely be the brokerage or the platform that you purchase the shares through. Now, as a retail investor, you cannot redeem IBIT shares in kind, which means your shares are never directly redeemable for Bitcoin. So who benefits from an ETF like IBIT? Well, the most obvious player here is BlackRock, whose ETF management fees are charged at 0.25%, and secondarily, the APs who can create new IBIT shares. Let's say the fund is trading at a premium to net asset value, or NAV. They can profit by selling those shares on the secondary market. That's the IBIT shares that you and I would buy. And conversely, if the IBIT shares are trading at a discount to NAV, they can swoop in, buy the shares, and sell them back to BlackRock's iShares Bitcoin Trust for a profit. This arbitrage is what keeps IBIT trading within a narrow band to Bitcoin's market price. The long and the short of it is that IBIT is a product that primarily benefits BlackRock, APs, and other institutional investors. In my humble opinion, it was not designed to benefit the ordinary retail investor. Before I talk about the risks of buying into ETFs, if you are learning something that you didn't realize before, please like and subscribe to my channel to get more content just like this. Make sure you click the notifications bell so you will be alerted when I drop a new video. Also, if you want to dive deeper into Bitcoin, make sure you subscribe to my Substack. The link is in the description below. Okay, let's look at the risks. The risks of owning IBIT are not unique to the fund. They are the same for all ETFs. When you buy IBIT, you're adding a bunch of middlemen between you and your Bitcoin. People don't generally associate ETFs with risk, but there is risk with any type of investment. Let me outline what these could include. First, there's counterparty risk. You are relying on BlackRock to manage the fund. You are relying on Coinbase to custody the Bitcoin. You are relying on regulators to keep the whole system operational. If any of those fail, you could be left holding the bag. Second, regulatory risk. Governments can easily change the rules around ETFs. They can freeze assets, they can impose special taxes, or restrict withdrawals. Bitcoin in your self-custody wallet is borderless and permissionless, while IBIT lives inside the heavily controlled financial system. If that system is locked for any reason, for example, entire share markets brought to a halt during a circuit breaker, or stops placed on individual shares like we saw with GameStop in 2021, you might not be able to buy or sell your shares even when Bitcoin itself is unaffected and still trading 24/7. So buying ETF shares in lieu of Bitcoin is to add layers of fragility and risk on top of the underlying asset. Beyond the risks of holding an ETF, what are the actual benefits of Bitcoin that you forfeit when you choose IBIT over Bitcoin? So first of all, self-sovereignty. With Bitcoin in your own wallet, you don't need permission to hold it or to spend it. With IBIT, you're still playing by Wall Street's rules. Number two, portability. You can't decide to send IBIT to someone else or use it to pay for something. You can with Bitcoin. Number three, censorship resistance. IBIT shares can be frozen in your brokerage account. Your Bitcoin, secured by your private keys, cannot. Number four, programmability. Real Bitcoin can be used in ways that IBIT can't, whether that's lightning payments, multi-sig security, inheritance planning, or interacting with Bitcoin native applications. IBIT is just a static financial product. In short, if you're holding IBIT, you have exposure to number go up, but you've given up exposure to freedom go up. Bitcoin is reduced to just a line on a stock chart. So why do people still choose to buy an ETF instead of the underlying asset? First of all, it's convenient. You don't need to learn about wallets or seed phrases. You can just buy it directly through your brokerage account like any stock. Second, it's familiar. People are comfortable with the stock market. They've used it for years. Bitcoin can feel overwhelming, technologically speaking, by comparison. Third, it fits into existing retirement accounts. In many countries, you can't hold Bitcoin directly on your 401k or pension plan, but you can hold an ETF. And in many cases, traditional financial institutions and advisors are restricted from advising clients to buy Bitcoin, or they are incentivized to sell IBIT shares instead because that's how they make a profit. And fourth, in some cases, holding IBIT shares might be more tax advantageous, especially in jurisdictions that tax Bitcoin punitively. So buying IBIT shares instead of Bitcoin solves issues of convenience and familiarity, but the trade-off is high. You're handing your Bitcoin exposure back to the very institutions that Bitcoin was designed to free you from. Sure, if you only want exposure to Bitcoin's price, then ETFs like IBIT can give you that. But if you want exposure to Bitcoin's freedom, you need to hold real Bitcoin in your own custody. ETFs can give you convenience, but they strip away the sovereignty, portability, censorship resistance, and innovation that makes Bitcoin revolutionary. So don't let Wall Street sell you a watered-down version of Bitcoin. Take the time to learn as much as you can about Bitcoin and how to self-custody it, because the difference between holding Bitcoin and holding IBIT is the difference between owning freedom and just renting something that resembles it. If this video helped you understand the difference between owning Bitcoin and owning a Bitcoin ETF, like and subscribe to my channel for more content like this. Also, check out the video that just popped up on the screen, recommended especially for you by YouTube's algorithm. Thanks for watching and see you in the next video.